Okay, in this session we're dealing with a flip side of the coin in a position to trade receivables, but in this instance we're dealing with trade creditors, also known as trade payables as well. So it will do us good to once again use a bit of our imagination in this imaginary firm or company that we own. We're still a manufacturing company that deals with clothing items. Only this time we're now looking at the side where we actually making purchases from our suppliers that would likely be supplying us with finished goods so far as clothing items. So in this regard, we are basically creditors to those suppliers. So when we're making those purchases, that therefore means that we need to recognize a liability because we would have gotten stock on credit which we would have to pay at a later stage. And once again, that liability of the outstanding amount of stock that we obviously owe to the actual suppliers would initially be brought down by payments that we would have to make in the near future. In other instances, it can also come about, be brought down by trade discounts that we could have been granted by the actual suppliers, or we could have been bad business people in some instances, and maybe we just did not pay, and our suppliers on the one end ended up having to write off that debt and essentially bringing it down on our side as well as, like, payments not made. So we will not delve into that though. We'll basically delve into the basics of just taking note of the actual liability being brought down by future payments, which we will basically make in the near future. So let's move our focus once again to the whiteboard. So I made some captions on the whiteboard just to actually save a bit of time. On this side, I've dotted down here a header of trade payables / creditors, and on this side I've got trade control account, in terms of that being called trade creditors control account. It can also be called trade payables control account. It's the same thing essentially. Okay, and on that side we've got payments, which is still in view, and hopefully on the last column over that side we've got creditors balance. Okay, so let's move back our attention now to the first and second column. So I've basically gotten down a debit over here, payments over here, and I've got a credit over here. So I basically want us to understand that when we initially made purchases, which are over on the left hand side from our suppliers, just as we spoke about earlier, we would have had to recognize a liability. So from our supplier A, we bought socks for 5,000 rands, so there's a liability of 5,000 rand we initially recognized, and dresses were bought from supplier B for 10,000, and supplier C we bought shoes for 2,500 rands, so that would have been recognized, and hats were bought for 2,000 rands as well from supplier D, and the last supplier being E, we bought actual shirts for 1,000 rands worth. Okay, so that's basically where we are, just to make sure we don't miss. So now that we are in the actual middle part of the control account, just to construct this control account, so we know that initially when we recognize a liability, we would have had to process a credit entry. For supplier A, it would have been represented by 5,000 rands worth of the stock that we took. All right. And of course, when we recognize this transaction initially, we would have obviously debited inventory, and we would have credited, credit payables or creditors payables or trade payables or trade creditors. I hope you get that. And for B, we would have recognized the liability of the 10,000 rands of stock we took, which was initially bought. And for C, we would have also recognized the liability of the 2.5 thousand rands when we took the actual stock of shoes, right? And for D, we would have had to recognize liability of 2,000 rands for the hats that we took. And lastly, for E, we would have had to recognize a 1,000 rands liability for the actual shirts that we took on credit. So over on this side, I've got payments made here. So I haven't dotted down anything for ease of getting through the session. I'm going to say we paid 2.5 for A, and for B we paid let's call it 5,000 rands. Okay, and for C we paid, let's call it 1.5k, right? And for D we paid, let's say we paid 2k, which was the outstanding amount originally. For E we paid, let's say we didn't pay anything. Okay, so that's where we are. So now we need to now recognize these payments that were made up against the original outstanding balance as a result of the actual stock that we initially took on credit. So once again, I'll strike down a line to differentiate between payments and outstanding. That's what I've got over there. So we made payments for A of 2.5 against 5,000 rands. So at least we made some payment there. And for B, we made payment of 5,000 rands against 10,000 rands. So at least once again we made payment there as well. And for C, we made payment of 1.5 against 2.5. So at least we made some payment there as well. And for D, we made payment of 2,000 rands in full, so which was pretty good, And lastly, for E, we made payment of 0, so we've been bad customers to our supplier either. We didn't make payment whatsoever, and that's basically where we are, just to bring this down a bit to capture that side. So now this is the payments that we've made. Maybe if we totalize it to get an idea of how far off we are. So we're going to say 2.5 plus 5,000 gives us 7.5 plus 1.5, that gives us 9,000 rands, plus 2,000 rands, that gives us 11,000 rands, plus 1,000 rands, that was not paid. I missed that, sorry. So E didn't pay, so it shouldn't have been 0. Sorry about that. This is correct. No payment was made. So payments that were made, 2.5 plus 5,000, that's 7.5, plus 1.5, that's 9,000 rands, plus 2,000 rands. That gives us a total value of payments of 9,000 rands that were paid against how much? Against 5,000 plus 10,000, 15,000 plus 2.5, 17.5 plus 2,000. That gives us 19.5 plus 1,000. That gives us 20,500, which was originally outstanding. 20,500, which was originally outstanding, against what is now captured to be a value of only 9,000 rands. which is not so impressive in terms of the liability that will be coming down versus the 20,500. So what is the balance in terms of customer A? He paid 2.5 against 5,000, so the balance in that regard would make it 2.5. And as for customer B, balance against 10,000 and payment of 5, for the balance would be 5,000 rands for customer, for supplier B there. And in terms of supplier C, it's a balance of 2.5 brought down by 1.5, which would be 1,000 rands. That's still owing. And for customer supplier D is 2,000 against 2,000, where we were really being fantastic customers to our supplier D there because we played in full, which is good. And for E, it's 0 against 1,000 rand owed. So we're being very bad customers in that regard. So if we totalize this, we should get an amount, when combined with this, should be giving us 20,500. If we don't get such, we have made an error elsewhere. That's where control accounting comes into effect. So 2,500 plus 5,000, that's 7.5 plus 1,000, 8.5 plus 0, 8.5 plus 1,000, 9.5. So that tells us we've got a value of 9.5. So already I can see that something is not balancing. We are out by an amount of 2,000 rands in order for us to get through to 20,500 rands. So let's do a quick check. Originally, A owed 5, he paid 2.5. B owed 10, paid 5,000 rands. So the balance there is 5, that's fine. So 2.5 was owed and payment of 1.5 for C, 1,000, that's fine. So 2,000 rands was paid, and that would be 0 in terms of the outstanding, that's fine. So 1,000 rands was owed and no amount was paid, so that's 1,000 rand. So where could we have gone wrong? Did we do right additions? Let's do that again to be in balance. 2.5 plus 5, 7.5 plus 1, 8.5 plus 1, 9.5. That looks correct. Maybe we should come over to the payment side. Maybe that's where we missed it. 2.5 plus 5, that's 7.5, plus 1.5, that's 9,000, plus 2,000, that's 11,000. So that's where we made the error. Now that's where the phenomenon of control accounting comes into play. Because now if we look at 9.5 plus 11.5, when we add these two together, they give us that. And remembering double entry is in play, so we're looking good. That is the effective manner in which control accounting is so effective, because it helps you identify the error just as we've identified it over here. So this will be the actual amount which will be brought forward in terms of the 9.5, which will be brought forward for the period of March, which is the next reporting period after February, because A had owed 2.5 and B had owed 5,000 rands and C 1,000 rands, D 0, and E of course owed 1,000 rands, which gave us a closing balance brought forward of 9,000 rands. And that's why control accounting is such an awesome thing to have, because the brought forward amount is what is now going to be the opening balance as far as our balances for creditors in March, opening balance. And that's how we close it. Fantastic.